Question is the impact of technology, it is real, it's definitely coming. Is it a threat? Well, for some of us it may be a threat. Is it an enabler or both? And I would now like to allow our panelists to introduce themselves quickly, maybe starting with Gabriella here, and I will now go from my chairperson role into moderator role and join my panel.
Okay, thank you. So my name is Gabriella Kindert. I've spent the last 20 years in private credit markets. Currently I have a portfolio of responsibilities. I am a supervisory board member at Mizuho. I'm having a senior advisor role by CVI, and I'm also, probably at this capacity, the most important. I am an advisor for the European Commission on alternative lending projects, so assessing grants for this sort of projects. So I see from this 800, several hundreds of projects trying to get some funding, and I'm fascinated by the amount of inspiration and new ideas I'm getting as a result.
Thank you. My name is Jeroen Conijn. I'm heading the FinTech and Structured Finance department within NIBC Bank. As a department, we focus on supporting FinTechs with financing, equity capital markets and debt capital market solutions, and also selectively supporting and working together with them in a more strategic way. Okay.
Dominick Peasley. I head institutional distribution for Funding Circle. I think some of the earlier panelists talked about bank lending. We've seen it increase to large-scale businesses by about 43% over the past 3 years, but the SME segment is declined by 3%. Funding Circle's the largest platform lender or tech-enabled lender to small businesses in the UK, the US, Germany, and Netherlands. We've originated and deployed around $9.5 billion. We have about 4.4 billion of loans under management, and about 70% of our global funding comes from banks, pension schemes, insurance companies, and the like.
My name is James Newsome. We founded Arbour 2010 as an independent influence in this market, having been 10 years at Merrill Lynch, we were quite independent, but not as independent as we would have liked. And at Arbour, yeah, we've really backed sponsorless lending, SME lending, and so groups like ICG, Cordette Capital, Beachbrook, Monroe Capital, others. And I'm pleased to see that the sponsorless world is still growing well. And for Arbour, yeah, technology is a big focus. So hopefully the next 5 years will be proved right again. Now, the first thing I wanted to do on this panel, we only have 30 minutes, and as the chairperson, I'll be an extra strict moderator. First thing up now, I don't know if anybody saw on the website, on the Super Return website, a piece that actually Gabriella put there. And I'm going to turn to you first, Gabriella, to set out the positive side of this, which is technology, an enabler. So, or where you think that technology can help with value creation, and we'll come to the threat part later.
Okay, very good, thank you. So the basic part of lending is actually measuring risk and matching supply and demand of capital. And if you just logically think about this, this is where technology can play a huge role by measuring and quantifying this. So there are 4 things that are actually quite new and we have not seen before. What is new here, the amount of data, the people who are becoming technologically savvy, don't forget about millennials, and they are very comfortable using new applications. The third thing is the fact that companies, consumer finance and companies, they are using digital underwriting. It's completely new, and James explained how important it will be. And the fourth is regulation, which enables these applications to plug in. So these 4 things will shake up our market significantly in 4 different areas. And the articles I wrote about actually outlines a number of concrete examples, but I would like to mention the 4 key areas where we feel, because I interviewed over actually 15 people for putting this together, where we feel the most important changes. One is the quality, the speed of credit underwriting, disbursement, and risk assessment, and also the process how companies, banks, and underwriters overwrite their own PD and LGD. So we used to do it once a year, it's going to be once a week. So I see this as one of the most important changes, combined with the amount of data we are using. Average, we have been using 20 to 30. Some of these new applications are using thousands of. The best example probably is Sesam of Hunt Financial is using 100,000. Secondly, liquidity and funding, number of new applications to create this matching. I'll let my colleagues talk about it. The third, James used in the introduction, probably we have seen this already in the last 10 years, reporting applications, Black Mountain and so on and so on. And the fourth one is data management. And that's where I see actually where we have a huge impact as a result of these new technologies, sharing data together, and blockchain will have a huge impact on that. So blockchain will fundamentally change how we share data, and I see a lot of private debt platforms plugging into these new applications like R3, like ING is doing, to share data and minimize compliance risks. So these are the 4 areas that we would like to talk about, and afterwards we talk about, okay, so what does it mean to you? But these are the 4 areas where we identified as a game changer.
So Jeroen, in terms of the fintechs that you've been working with, that you've been backing, which of those areas that Gabriella set out have you seen people focusing on? Is it data management? Is it due diligence, underwriting?
I think that's probably not a good answer, but it's on all areas. But if you look at underwriting, I think that's a key element where they use the data. And I think it's also a bit of chicken and egg story, because they need a lot of data to improve their underwriting. So there, I think there's the real challenge, and I see them doing it very well for a certain segment, and I think that's also a good development.
So for the people who are developing digitalized underwriting, is their customer base our market? Is it that they will then have software as a service, so that managers in our sector can use their digitalized underwriting? Or are they people who will set up, are they more vertically integrated, they'll set up and actually do underwriting and make loans themselves, or act as a platform like FundingCircle?
I think they can actually do both.
Yeah.
Mostly started with underwriting for themselves, but the same techniques can be used for supporting underwriting by others. To give an example, if you see Oak North, which offers that combination with Oak North and Acorn, which provide it as a service, but also for their own book.
Yeah, I mean, Oak North, I mean, there are managers in our market, I mean, all of us in our market, we've sort of acted like the tortoise. And the tortoise, the tortoise and the hare, I mean, if there's ever been a hare, it's Oak North. I mean, when was it founded? 5 or 6 years ago, and it's already an extremely valuable company and is doing a lot of credit. Yeah. And actually, interestingly, what surprised a lot of us about Oak North is that they're focusing on a section of the market where you'd imagine that alpha is most required, because it's growth lending rather than, we'll turn to Dominick now, rather than SME lending for established community businesses. Actually, they're quite high growth companies, but Oak North's acting as a bank. Okay, so then Dominick, coming on to you. So having heard these areas where tech is an enabler, where has technology mostly been an enabler for FundingCircle? Is it in finding the SMEs? Is it analysing the SMEs, or even finding the investors? Don't say all 3.
No, I won't. It's very tempting to. We use tech on both sides, as you can imagine. So that is everything from looking at how we acquire borrowers, so purchasing data that's available in the market, being able to slice and dice that data to drive marketing campaigns, test marketing campaigns, and then using tech off the back of that to actually analyse how those campaigns are going and which ones are more profitable in terms of conversion, and looking at the quality that we're bringing to the top of the funnel. And then from the underwriting side, we're looking at everything from the consumer side through to the commercial side, and being able to link different risk models together to be able to make an objective assessment of a business. And these are things which, coming back to Gabriella's points, you weren't able to do sort of 10, 15 years ago. The change in regulation, so whether that be open banking here, whether that's CCDS, which is less talked about, but I think just as important when you're looking at the world of SME, so that is the provision of corporate bank data into the rating agencies and being able to pull that data and be able to manipulate that as factoring that into probability of default models is just as important. I think, there are some people that will talk about various different ways of underwriting, whether that's sort of using AI now or whether that is looking at social media, social data. I think all of these areas have a role to play. I think the market is probably, in certain areas for that, it's a little bit early, but it is, I think when you start talking about things like AI, there are some unintended consequences when it comes to underwriting. I think you have to introduce those things very slowly and monitor it. But all of these areas are an enabler now for a market which is growing massively. You look at the UK and you look at the SME segment, that is 60% of GDP. It's 60 to 70% of private sector employment. It is a market where, if we look only 5 or so years ago, only 1% of companies were looking at a platform lender before a bank. Now that is 5%. It may not be a small shift, 1% to 5%, but that is an immense amount of growth and an immense amount of market dynamic that's changing as well. So I don't think this is now an area which can be overlooked. And I think institutions, as they start looking at this and they start delving down, see it as an enabler for deployment as well. But
we should, keeping it practical for everyone in the audience here who think that we've come from the space age and it's not relevant. I think you guys have done, I think Funding Circle's done a deal with one of the biggest traditional direct lenders where they've put $1 billion with Funding Circle.
Yeah,
and we know them, I won't even mention them by name, but we know them as one of the top 5 direct lenders. And there are other groups, for example, like TKO is involved in has bought a tech-based lender in France. But Gabriella, back to you. When we're talking just on the enabler point before we come to the threat point in a second, which may be even more exciting, is it really, what would you say to people in this room who might be thinking, look, I want to have, there are 2 people in this room who might be skeptical, the GP and the LP. Let's take the GP first of all. The GPs might be thinking, I really like to have my team spending hours, days or weeks poring over a document, which is the intercreditor agreement. And if I start digitalizing that, maybe I'll be speeding things up, but I'll be adding more risk. So for a GP, again, in practice, how would you say, and maybe to put this in real terms, do you think that people doing loans between 2 million and 200 million are going to be using technology, or is it really going to stay in Funding Circle's world where they do loans up to 1 million or whatever it might be?
It's a great question, and I have been thinking a lot about this actually. Depending what you are focusing on, that's where technology can play quite different role. For larger, technology, by the way, always favors the biggest players. Yeah, so technology, if you look at data selection, technology is quite expensive to run and develop. So for a TKO or a large or RS or a GP focusing on larger segment, technology could have a very different meaning than a granular portfolio like Funding Circle. They can use artificial intelligence in selecting what are the key risk assessment areas, or a bank identifying a risk by connecting the software, the accounting software with the borrower and see risk before we saw risks, identifying trends in comparison with last year's, or just funding needs and so on and so on. So technology can have very different meaning than for a granular portfolio like Funding Circle, and it also boils down to cost and benefits. Yeah. And these benefits, we haven't talked about it with Funding Circle, but think about the data advantage Funding Circle will have over 5 years. So at one point of time, they will have the most important data to identify PD and recovery for SMEs. So technology, depending on your size and your focus, can mean advantage to you, either data or underwriting. But those who are ignorant on this, the big picture is changing very fast. Just think about Goldman Sachs. If I had said 10 years ago that Goldman Sachs will get into this consumer finance market with Marcus, you would have killed me. If I had said to you that PayPal will have 6 times or 7 times the market cap of Deutsche Bank, you would have killed me.
So we'll come to the threat. Okay, so then on the LP side, and sorry, Jeroen, we'll come back to you in a second. On the LP side, we're still talking about whether technology is an enabler. So are we seeing any innovation for LPs? How does it actually help? Because wouldn't an LP rather think, I have these 20-year experienced geniuses in this GP who are spending 3 months over one loan, and the LPs might think, well, I don't want to go into black box. I don't want to have algorithms selecting credit, because credit is a people business. And this is, of course, how a lot of people will defend. So maybe, Gabriella, briefly you, and then maybe Dom, because I know you work with LPs. Why does it help LPs?
It all boils down to origination. Which origination is changing more from manual to digital, and you have to control that. So if you have access to those credits, you have an advantage. And via data, you have advantage to price risk, and via transparency, via data, you create transparency for LP. So I can easily see a world like instead of we have a conference like GP LP, we have platform LP conference, because you want to have a direct access to the people who actually have access to the customer, and this is changing from a relationship-based to more digital-based approach.
I mean, I completely agree, which is not great on the panel. But when we start looking at from an LP request, and some of it was touched on earlier, it's diversification, deployment, yield, credit quality, speed of deployment as well, duration of the assets, whether they're cash generative. As a platform, that's exactly what we can do. We can originate, and we're not reliant. We talk about sponsored and unsponsored. We're not reliant on financial sponsors. We can tighten credit almost instantaneously when we see trends going on in the market. We've seen in the markets where we've been able to reduce lending to certain segments of credit to tighten credit risk when we've been seeing deterioration in an area. These are all things which, as an asset class which has a relatively short duration and high cash flow coming off it, enables you to do. So when we talk about what are we creating, we are creating an asset which is very easily consumed by an LP as long as it is in the right structure. And the data coming off that enables you to do some very interesting things. We've done a lot of work in economic impact investing, so looking at the number of jobs being created, looking at the impact on GDP, using that underlying data to go down to the postcode level to provide specific reporting. These are all things which are being enabled by technology today, which again weren't available 5 years ago.
Okay, so Jeroen, so as well as backing fintechs as you do, and perhaps in other parts of your business, just finishing up on the enabling, is there any other area where you think that technology, and if you can also think a little bit about the traditional mid-market, which is mostly represented in this room, where else do you see technology being an enabler?
Yeah, well, I think we are in 2 areas. So we go to our fintech clients, and I always get very enthusiastic and also see that these they are doing things we also want to do for ourselves. And that's actually what's also happening. You talked about where's the alpha, but I think if you look at the traditional credit process, I think 80% of that process has nothing to do with the alpha. So if you can enable that by having the tech in, you can focus on the alpha. And I think that the examples you gave are also doing that, because it's not entirely gone, but you get all these interesting analysis available, and you can focus on the things that really matter also in the mid-market area.
Yeah, okay, I think that's right. That's very good. That's why we refer to sort of tech-enabled lending rather than tech lending. Yeah. It's speeding up and taking the inefficiencies out of the underwriting process to actually get that deployment speed down.
Yeah. Okay, so then thinking a little bit more about the threat, I mean, is the threat, when we think of technology as a threat, I mean, for, again, LP, GP, forgive me being a traditional guy who thinks in those terms, but for GPs, are any of you saying that this is a bit of a zero-sum game, that as technology becomes more and more robust and data becomes better and better, actually this SME market could become as attractive as our mid-market? And I think we've seen the numbers, there's 150 million SMEs in the world. I think how many, 200,000 have received credit from platforms so far. There's a hell of a long runway there. The yields are similar. The transparency is better. The granularity is better. So does anybody think that our traditional mid-market may actually suffer from a tip of investor money into tech-led credit, or will there always be space for those of us who have this alpha world with 1.5% and 20% above a hurdle? And maybe Jeroen, first for you first of all, because you're working across both sectors. Do you see that do you see the new tech-led market as actually a threat to the mid-market, or will they always coexist?
I think they will coexist naturally, because I think there's also interest in these larger companies, and you cannot really do that without also the alpha and also the analysis, is my strong opinion. But this allows investors to make a better comparison also for the SME market. So I definitely think there will be an inflow to the SME market.
And also it will raise the expectations in terms of reporting, underwriting standards, risk assessment. So it will be very difficult for smaller GPs to keep up.
Yeah.
So in that sense, it's a threat, but it's good for us as the consumer of credit that we see more competition for the existing players. Do you see any business models that do need to adapt rapidly, perhaps in the infrastructure of how our market works? Do you think that law firm, because there's a lot of legal tech is actually a growing area, maybe you've even backed some fintechs who do legal tech. Do you see any business models changing completely over the next few years because of technology, whether it's the administrators, the lawyers, or do you think people will always find their way and maybe use technology just to enhance what they do? Maybe to you again, Jeroen.
I already see that happening, so especially on the data collection, and also either parties who have the data and try to use that also for other purposes, or team up with other parties. So for instance, in the Netherlands there are also parties working together to get combined databases, and also parties making analysis of those data. So that's something I see happening. Yeah. And on the other, like law firms, I think there will be a difference. So if parties cannot adapt, I think the space they will operate in will be definitely much smaller.
Smaller, yeah. And so in terms of the unicorns, so when we think of the big star firms that came out of the kind of 98 and 2002 are the firms we all know as GSO and ICG and Ares. Do you think that, well, leave Funding Circle out of this, do you think that Gabriella, do you think that the star firms that come out of perhaps this tech shift, will there be any that you might call infrastructure firms, or will they be asset managers again, like Funding Circle? Can you see anybody making a big business out of the infrastructure of how our market works?
I think they will use the relationship they have with investors and the reputation, and they will buy these small firms and they adopt it. So I think it will be the other way around, to be honest, because they have the capital, they have the network. So they will buy some smaller firms and they will use that for the smaller. Actually, you see it already happening. Some of these players bought fintech firms for SME lending, but I think the biggest lending opportunity right now is making consumer finance and SME more efficient globally. Yeah, that's the biggest lending opportunity today, where I see the biggest game-changing happening.
So we've got a couple of minutes open to the question, but one more. So in terms of predictions from you guys, back to my LP-GP traditional dichotomy, sorry, but we've had so far, Dominick, I think if I've got the numbers right, we've had so far institutional commitment to tech-led lending has been only between 50 and 100 billion, I think, cumulative over the last 5 or 6 years. So where do you think it could go to? We've done, as a market, we've done about 800 billion in private credit since 2010 in traditional direct lending. Do you think it could match that, the institutional commitment to tech-led SME lending?
I actually think it will, because when you look
would
at
say that.
when you look at the volume of businesses that you're looking to fund, and you're looking at the contribution to GDP that these businesses create, it is, as I mentioned earlier, around 60% of GDP globally. This is not a small segment. I think the biggest hurdle is actually suppose, education, both from the LP side as well as the borrower side, and it's people getting comfortable with this type of origination. I mean, we've seen it now. We have supranationals lending through us. We have insurance companies who've ripped us to pieces for 2 years of due diligence and are allocating in private debt structures now through our business. But it is still at a nascent stage, but the pace of growth is massive.
But Gabriella, do you think this could be cut off if there's poor performance in a cycle? Or I mean, we won't let Dom advertise himself, but I know these guys do say that actually SMEs performed better in the last crisis than private equity-backed companies. But do you not see a threat that it might kind of go away if there's just a bad experience for investors?
I think it's a beta approach. You know, you create a granular portfolio in consumer finance and SME lending, so I think it's, in a way, it's more resilient, and it's linked to the overall GDP of the country.
Yeah, I'd agree with you. I think you can argue which is more resilient, which isn't, but actually the great thing about tech-enabled lending and this segment of the market is you have data going back a vast number of years for you to be able to build models off, build stress models off, and look at the behavior of this asset class through different types of recessionary environments, which is also key.
Okay, so to summarize, this panel, this expert panel believes that it's both. Have I got the question right? Or both? Yes, so we're going for both. There will be a large tech-led SME market. It's going to be very big. There will be some businesses in our market that will need to adapt. But in general, this is very positive. Thank you to this panel.